A very warm welcome to you all. My name is Tibet Kara. I am the Secretary General at the British Chamber of Commerce. It's great to see so many familiar names among the participants. We're very happy to present you a very important webinar today. A topic very close to our heart, unfortunately, inflation and how to manage that inflation better. We need reliable insights. So we need a good advisor to tell us about what to do. So we have great speakers today. We will have two sessions. The first session will be presented by Cerebra CPAs Advisors by the managing partner Fikret Sebilcioğlu. And the second part will be about the legal implications on inflation and the environment. And that it will be presented again by Pekin Mizrahi, who is the senior partner from Pekin Bayar Mizrahi, and Fatosh Otçoğlu, a partner at the same firm. And then we'll have a speaker all the way from UK. James Lockwood, who's the partner at Norton Rose Fulbright UK, and they are partnering with Pekin Bayar and Mizrahi. I will let speakers to introduce themselves, and with this note, I will hand it to Fikret Sebilcioğlu. Over to you. Enjoy your webinar. Thank you.
Thank you, Tibet Hanım. Hi, everybody. My name is Fikret Sebilcioğlu. I'm the managing partner of Cerebra CPAs Advisors. Cerebra CPAs Advisors provide services in the areas of accounting compliance and reporting, forensic accounting, fraud investigation, and ethics and compliance. And first of all, I would like to thank to BCCT for creating such a good opportunity for us to talk about very difficult and very interesting issue. Inflation, and also I'm very delighted to be a part of this event together with my esteemed colleagues from Pekin Bayar Mizrahi and Norton Rose Fulbright. Inflation is an economic phenomenon in the last couple of years for Turkey, definitely, and also globally it's taken lots of attention from many countries because as a result of most recent political, financial, and economic instabilities, lots of countries are just facing inflation reality. The title of our event is Implications of Inflationary Environment in Turkey and How Can You Protect Your Company from High Inflation? So we are going to talk about the impact of inflation on companies, inflation risks, what kind of actions you can take. But I think there is a limitation here. I must underline, we are not economists. We are not going to talk about why inflation occurs, what are the reasons behind it, and how inflation can be eliminated. We are not going to talk about these issues. We will just focus on actions based on our expertise that you can take to mitigate these risks. Inflationary risks. And I think if we are talking about risks, I think we should also consider, I encourage you to consider during this event, the opportunities that we can exploit. Because if we are talking about risks, there must be some opportunities as well. So I encourage you to navigate this kind of opportunities you may have in your industry and in your company. Let me share my presentation. Yeah. Ergin, does it work?
Yes, I see full screen.
Yeah. Okay, great. Thank you. Sorry. So the issues I'm going to address during my speech as follows. The first, I'm going to talk about the indicators of an inflationary economy and the current environment in Turkey by giving the qualitative and quantitative indicators. And then I'm going to focus on possible impacts of inflation on companies, on business processes, and how they can protect themselves from during the periods of high inflation. And then I'm going to propose a tool or mechanism, whatever you name it, inflation accounting, and how you can apply it to in managing the risks arising from inflation. Before getting into any details, I want to focus on two concepts because I'm going to refer very often during my speech: monetary items and non-monetary items. You should understand it while you are assessing the inflation and the impact of inflation on your company. Monetary items are items like such as cash, trade receivables, and trade receivables. As you can see, they do not retain purchasing power. They keep the nominal value. On the other hand, non-monetary items, there are property, plant, equipment, inventories, goodwill, patents, paid capitals, retained earnings. So these are non-monetary items, and in the inflation, actually, they retain purchasing power itself. So during my speech, you will have much better understanding. But now you know monetary items and non-monetary items. Just for visualization, just the visualize balance sheet, you see on the asset side, cash, bank, trades, receivables, they are all monetary. But as I have just stated, inventories, tangible, intangible assets, and others non-monetary. On the liability side, as you see, trade payables, tax payables, or provisions monetary, and the rest, like capital or deferred income, they are non-monetary. The definition of monetary and non-monetary are quite critical because in the coming slides, I'm going to refer to inflation accounting, and all these items are treated if they are monetary or non-monetary. And based on this, the financial statements are adjusted according to the price indices. Okay, let's talk about indicators of an inflationary economy. High inflation actually is characterized by some indications. Most importantly, wealth is kept in non-monetary assets. I've just mentioned what non-monetary assets are, like fixed assets, like inventories, or in a stable foreign currency to maintain purchasing power. So at this stage, I want to stop once again, like monetary and non-monetary items. Purchasing power concept is also quite critical in inflation, understanding inflation and fighting against inflation. Purchasing power is the amount of goods or services that a unit of currency or money can buy at a given point in time. In an inflationary environment, as you will imagine, money loses purchasing power. So as time passes, you purchase less goods or services. And the other indicator, monetary amounts are regarded not in terms of the local currency, in our situation, Turkish lira, but in terms of a relatively stable foreign currency like euro or US dollars. And actually prices also may be quoted in that currency. And we are, as Turkish citizens, we are quite familiar with this fact. Sales and purchases on credit take place. They still take place, of course, in inflation environment, but at prices that compensate for the expected loss of purchasing power. Because within the same financial periods, a monthly inflation could be very high. Therefore, this kind of sales or purchases should take into account the expected loss of purchasing power. And other indicators, interest rates, wages and prices are linked to a price index. So I especially draw your attention to the wages. I will come back to that point. So these are the qualitative indicators. Let's talk about the quantitative indicators. So what we have to do, we have to look at the consumer price index. So this is the situation in Turkey as of September 2022. That's the comparison with September 2021 and September 20. As you see, from 11.75 in 2020, it increased to 19.83 at 2021. And then you see a dramatic increase in the last 12 months. And inflation raised to 83%, almost 83% as of September. So quantitative facts are also showing that Turkey is a high inflationary country. Okay, I want to touch base very shortly the possible impacts of inflation on companies, on business processes and strategies and policies. Investment, needless to say, the inflationary environment creates lots of uncertainties. The investors don't like uncertainties, and therefore investors or companies, they are hesitant to make investments in such times, or at least they wait until they can foresee the future better. And inventory policy is one of the most important policy impacted by the inflation, because as I said, inventory is a non-monetary items, and in these times, companies, they tend to purchase more non-monetary assets in order to maintain the purchasing power. Therefore, companies purchase more inventory, they keep more inventory on their assets. But this creates another problem, because on one hand, they create non-monetary assets, they purchase non-monetary assets, but in the meantime, they keep less monetary assets, which creates working capital requirements. In such an environment, also getting loans from the financial institutions could be quite difficult. So it's a big challenge especially for trading companies and production companies to handle this balance. And in such times, even inventory prices could be much higher than the inflation. I mean, that's the situation in Turkey. If you look at the production price index, you will see that it is much higher than the consumer price index. Second, the other important issue, production policy. So it's in line with the inventory. Production is a big challenge in the inflationary environment. As you know, the companies try to find an optimum production level where they make the optimum and or highest profit. However, in the inflationary environment, this is quite difficult. There are two reasons, actually. One is, I've already mentioned, inventory. Inventory prices increases very fast, even more than the inflation. And the second issue is that the production takes some time. And it takes time from the production of the goods until the sales of the related products. So in this period, it's pretty difficult for companies to estimate the replacement value of the related costs, raw material costs, consumables, general production costs. Therefore, as a result of these challenges, it's pretty difficult to determine the cost prices, and as a result, sales prices and even the marketing strategy of the company. And other policy, sales policy also impacted. Needless to say, sales prices increases very fast. As I have already said, purchasing power, money lose its purchasing power, so the prices increase very fast. So therefore, as a result of production policy, marketing policy, sales policy, they are all having lots of challenges to determine sales prices, and also the alternatives, how they can reach their target in such an uncertainties, in such an environment where uncertainties exist. Salary policy, I've already mentioned that salary policy, I think in the last 1 year, all corporations face this challenge. Everybody tried to maintain its living standards, of course, and as a result of this, the companies and the employees had and still having quite big difficulties, and therefore it has an impact on the company's salary and HR policy. So it's one of the biggest challenge, and I think it's going to continue in Turkey for some time. And last but not least, accounting and financial reporting. And actually, all these impacts appear on the accounting and financial reporting. In this slide, I'm going to focus on the implications of inflation on accounting and financial statements. So obviously, after giving all this information, you will come up with the fact that traditional financial statements, that put it this way, or financial statements which are not adjusted for inflation, would reduce the informative value for the reader of the financial statements. I think the key word here is misleading. The financial statements which are not adjusted for inflation definitely will be misleading for the readers. So you wouldn't simply compare the financial statement with the previous year's financial statements. And particularly during the year, based on the budgeting and forecasting process, you should know your numbers, most recent numbers, in order to predict the future. So if the numbers are not adjusted for inflation, this is really a big problem for companies. In this period, non-monetary items appear to lose value and actually completely could be undervalued over time. And as a result of this, the company shows very high, but actually fictitious profit in the income statement. And all these issues actually create challenges for entities in making operational and financial decisions. So it's pretty difficult to make right decisions if you do not adjust your financial statements. When I'm saying adjustments to financial statements, I'm just proposing here that you should do something to change your financial statements, and as a result, you will have much better picture of your financial position and financial performance. This is the inflation accounting. And actually, inflation accounting is quite well known globally as a result of IFRS, International Financial Reporting Standards. This is a technique actually, as a tool, kind of tool for companies to adjust financial statements according to the price indices, rather than just relying on the cost accounting basis. As you know, the companies normally, in accordance with their accounting standards, they state their transactions based on the cost accounting basis. However, in the inflation accounting, we do adjust the numbers. But I must underline here, our effort, our target is not present or state, sorry, the numbers at the market value. This is not our purpose here. All we are trying to do here to state numbers according to the price indices. That's all. And actually, objective is to state financial statement in terms of the measuring unit current at the balance sheet date or at the end of the reporting period. In terms of the measuring unit current, it means that all we are trying to do, show all the numbers on the balance sheet, on the current year balance sheet or the comparatives at the same purchasing power. So it's going to be a comparison apples to apples. Or we are going to speak the same language. Then we can have much better understanding of the financial position and the financial performance of the company. So here, just information for the audiences. I'm sure here there are many participants here representing foreign companies established in Turkey. Foreign companies reporting in Turkish lira may be required by their head office to apply inflation accounting for consolidation purposes. Actually, with effect from March 31st, March 2022, Turkey has been recognized as a hyperinflationary environment in accordance with international financial reporting standards. So if your head office prepared their financial statement, consolidated financial statement based on IFRS, then you may be required to prepare your financial statements in accordance with inflation accounting. But if you are not required, my recommendation is to in any way apply this just for your understanding of your financial statements better. Just for your information, inflation accounting is not a requirement for Turkish entities at the moment. Briefly, I will just touch base a couple of things, how you can restate financial statement. Let's talk about balance sheet. We've already talked about monetary items and non-monetary items. Monetary items, we will not touch monetary items. We will keep it as they are. But we are going to adjust non-monetary items in accordance with the price indices. It's so complex, it's not possible to get in details, but just an example to visualize how it's going to work. Because, for example, we are going to change all fixed asset numbers, the fixed assets balances in the inflation accounting. Say, we prepare balance sheet at September 30, 2022. We purchased fixed asset on January 2022 in the amount of 1,000 Turkish lira, for example. And at the end of September, it's announced that price index is 83%. Inflation rate is 83% for 9 months. It means that if we prepare a financial statement at September 30, 2022, the fixed asset will be adjusted as 1,830. So actually, we are going to create a new fixed asset register. This is the same for inventory, and actually all inventory numbers will be changed. It means that cost of sales also will change. And second phase after balance sheet, profit and loss. All profit and loss items should be restated based on the price indices. So we should state them at the measuring unit current at the end of the reporting period. And normally the best situation that we must restate them based on the dates when the items of the income and expenses were initially recorded. However, in practice, it's almost impossible. It's very difficult if you are not using a very good ERP system or software. Therefore, in practice, monthly profit and loss items are adjusted using the monthly price indices. However, we should be careful because certain items in the profit and loss should be plug-in numbers. What I'm trying to say, for example, depreciation, because we created a new fixed asset register, therefore our depreciation would be different. We created a new inventory balance, therefore cost of sales table, purchases, year-end inventories are different. Therefore, cost of sales would be different. So what we are going to do? We are going to take out the numbers based on the cost accounting basis, and we are going to plug in the new numbers calculated based on the inflation accounting. And last but the least, one of the most important issue in the inflation accounting, gain or loss on net monetary position. All this practice will lead to one account, which is called monetary gain loss in the profit and loss. It's not possible to explain now, but as a result of all these adjustments, there will be an imbalance in the profit and loss and the balance sheet. This is called monetary gain loss. This monetary gain loss is the result of the all implication of inflation on the company's balance sheet and income statement. So this is a part of the profit and loss, included in the profit and loss, and it's the indication of the company's, it is the gain or loss on the net monetary position of the company. So that's all on my side, but yes, one more point. I think this is the one of the most critical and difficult one. Okay, you can prepare your balance sheet and profit and loss at certain balance sheet date. However, this practice could be a part of your budgeting and forecasting mechanism. This is difficult, I know, but in order to make best decision during the year, considering that the monthly inflation also quite high, that would be great to integrate in a simple way, maybe, to integrate the inflation accounting basics into your budgeting and forecasting process. Then you will have much better estimation of revenues and expenses. But I must admit that it is difficult. Thank you for listening to me, and Ergen, it's on you. Let me stop here.
Thank you, Fikret. That was very informative. Let me start off by sharing my screen. Okay, you can see my full screen, I
Yes,
think.
not yet. Yeah, no.
Thank you. Let me start by introducing myself. I'm Pekin Mizrahi. I'm a senior partner at Pekin Bayar Mizrahi. We are a full service law firm in alliance with Norton Rose Fulbright. I will let my other two colleagues introduce themselves as they speak. But let me summarize what I will be speaking and what Fotosh will be speaking from a legal perspective coming from Turkey. We will talk about a number of factors. We will identify the problems and try to come up with possible solutions. To start with, we will talk about what can be done about current contracts. Then we will talk about what we can do about the future contracts that we will sign. We will also discuss the huge difference between the default interest rate and the inflation rate, and what we can do about that as well. And lastly, Fotosh will talk about Decree No. 32, which I'm sure we all know, but she will provide some further insights. To start with what we can do about the current contracts, of course, the law has a simple principle that contracts must be complied with. This is coming from Roman law. For so many years, it's called Pacta sunt servanda. But this principle is not without any exception. Although the principle is that a contract should be applied exactly as it was originally agreed, the exception is that in certain exceptional cases, to do so would be contrary to justice, honesty, and fairness. That's why in law, we have an exception rule, which is called rebus sextantibus, another Roman name, another fancy name, but it does give a lot of room for an applicant which wants to get rid of a contractual stipulation and wants to adapt it depending on the current circumstances. So the principle allows a contracting party to go to the court or to an arbitration tribunal, depending on the case, and request the adaptation of the contract to the current circumstances. This can be, for example, price adjustment, depending on the case, or the rescission or the termination of the contract, depending on what type of contract it is. So basically, a party is entitled to ask from the court to intervene in the contractual relationship between the parties and to revise the contract having regards to the exceptional circumstances at the time of the application. Today, this principle is accepted almost everywhere around the world, and we also see it in international law. For example, we see it in UNIDROIT principles. We also see it in CASG. Starting with 2012, we have started seeing it as a codified law in our code of obligations. Before that time, we had it in our case law and in scholarly work, but it was not in the law. With the codification of the new code of obligations, we now have a statutory element that we can benefit from. I usually hate reading from slides, but I think in this particular case, it's necessary. I want to go quickly about what the conditions of applying for hardships are. The first condition is that there must be an extraordinary situation which is not foreseen at the time of the entrance into the contract, and which a judge could not have expected from the parties to foresee at that time. Secondly, this condition should not arise actually from a reason attributable to the debtors. It should arise from an outside factor, such as inflation, as we will speak. The third factor is that the changes will change the circumstances at the time of the contract against the debtor in such a way that to demand the performance of the debtor's obligation would violate the rule of honesty. But more importantly, the debtors, when they make the application, should not have fulfilled their obligations or have performed them by reserving their rights resulting from hardship. So after you cannot go to a court after you performed your obligation and said, you know, you were mistaken to have fulfilled it. you're now sorry, and ask the court to adjust the contract based on the current conditions. That's not possible. And lastly, the debtor shall have the right to request from the judge the adaptation of the contract to the new circumstances, and if this is not possible, to rescind the contract. But it's very controversial whether this can be done at the times of high inflation, especially in Turkey. And here is why. We have very conflicting case law, chambers of the Court of Appeal, different chambers deciding in different ways, and sometimes they're deciding differently, having regards to their previous decisions. So it's fair to say, from the beginning, I think, that each situation should be assessed by its particular conditions, and it's very hard to define a general set of conditions applicable to the inflation. But we are seeing conflicting case law. On the left-hand side, I will quote from those precedents which say that inflation cannot be seen as a hardship. And on the right-hand side, I will quote from those precedents which say that it must be done so to ensure fairness. When we look at the red ones, we primarily see that the Court of Appeal is essentially saying that you are a merchant, you are living in Turkey. Economic hardship is not something that you're not accustomed to. You have lived it in the past for many times. And that's why it's not unexpected. You should expect, as a prudent merchant, that inflation may happen in Turkey, economic downturns may happen in Turkey, and that's why the element of unforeseeability does not qualify in inflationary circumstances in terms of hardship. But again, there are conflicting case law which suggests that inflation is an extraordinary situation, which maybe amount to a war or other, godly, let's say, phenomenon that is beyond the control of the contracting parties, which is also capable of fundamentally altering the equilibrium of the contract. And that's why hardship can be invoked in those circumstances. And of course, there are scholarly views which support the position that I have just stated. And they're saying, economists themselves cannot predict what the inflation rate is going to be next year. So why expect from a merchant to make that kind of prediction, whereas an economist cannot do it? Therefore, I should stress that it's very difficult to opine whether it is possible to successfully invoke hardship at an inflationary environment. And of course, we should consider, when you go to a court and you ask your contract to be adapted, when you ask a judge to intervene in the contractual relationship you have with your contracting party, that judge must may be in a position to repeat their own action in many other circumstances. And the court system may be faced with a situation where everyone is applying for the adaptation of their contracts. And of course, every judge in Turkey is forced to adapt the contracts in ways that they believe are just, having regards to the changing circumstances. So maybe it is much easier to establish a successful result based on the hardship clause if you are litigating your claim, for example, before an arbitral tribunal, because that will be a limited one-off event, limited within the scope to those parties to the arbitration. It will not set any precedent in terms of case law. So, from a practical perspective, I believe that an arbitration claim will be more successful than a court claim in Turkey. But even in a court claim, this is possible. That was what we can do about current contracts. For future contracts, I think we should always keep in mind that the hardship clause, Article 138 of the Code of Obligations, similar stipulations can be included in contracts according to the needs of the parties. This is allowed. So you can state under which conditions, the parties may ask for the adaptation of their contracts. You can set certain thresholds, you can set certain conditions. They must not be in parallel with Article 138. So I think from this moment onwards, it is prudent to think about this possibility, because while we do not wish and expect the inflation to be more than it currently is, it is always a possibility. And this way, you may guard yourself against any adverse effects that future inflation may play in your contracts. This can be done, for example, by way of adjusting the prices in respect of the inflation rates. You can say, the price will be adjusted if the inflation hits 40% or 60%. Any similar type of stipulation can be included in contracts. One other issue that I want to discuss myself is the huge difference between the current default interest rate, which is a debtor needs to pay as soon as they stop performing their obligations and interest begins accruing on their obligations, and what the inflation rate in the country is. The current standard default interest rate is 9% in Turkey, and the commercial default interest rate is 15.75%. Whereas, as Fikret Bey has stated, the current inflation rate is above 80%. So this is a graph. It's not a 100% accurate graph because the lower mark shows the policy rate of the central bank. But because it's the average of the contractual and standard interest rates, default interest rates, I want to use that as an example. And it shows the huge difference between the inflation rate and the default interest rate. Of course, if the creditor will be placed in an immensely bad situation where if they're not paid on time, because their receivable will be depreciated against the inflation in such a high rate when compared to the default interest rate. They will essentially lose money because of inflation. The President of Turkey is allowed to adjust this statutory interest rate. It has not been yet done. It may be done in the near future. We don't know. But I think it's prudent to factor in this possibility in our contracts. And merchants can decide what the default interest rate will be in their contracts. In fairness, it has been contradictory and controversial in our law whether this could have been done, because Article 120 of the Code of Obligation actually states that the contractual amount of default interest rate cannot be more than twice of the amount of the statutory rate. But it has always been controversial whether commercial contracts are also subject to this statutory provision. There have been many conflicting case law on this issue, but research shows that in most recent case law, without any question, the Court of Appeal has said that commercial contracts will not be affected by this statutory provision. Therefore, you can't say in your contract, for example, the default interest rate will be, let's say, 10% more than the current inflation rate at that point in time. So that will protect you against the downside of the difference between the inflation rate at that time and what the statutory default interest rate at that time. So I want to end my presentation here. I hope you enjoyed it. We can come back, of course, and Q&A, and I will leave the floor to Fatosh.
Thank you, Ergin. And good afternoon, everyone, and thank you for joining us in this webinar today. My name is Fatosh Otçoğlu, and I'm practicing as a banking, finance, and capital markets partner at Pekin Bayar Mizrahi. And today I will talk about the well-known foreign exchange restrictions covered under the Decree number 32 on the protection of the value of Turkish lira. As we are all aware, starting from 2018, when the first significant fluctuations were seen in the position of the Turkish lira, remarkable restrictions were introduced by the presidency of Turkey to the decree number 32 to prevent the circulation of foreign currencies while increasing the utilization of the Turkish lira. And these were mostly done through prohibiting the contract price of certain agreement types to be denominated in a foreign currency or indexed to a foreign currency between real persons and legal entities residing in Turkey. And of course, during the years, certain exemptions were introduced to these FX restrictions due to the practical difficulties experienced within the commercial sector. But generally speaking, payment obligations under employment, service, license, and work contracts between persons residing in Turkey, which mainly has no element of foreigners, are forbidden to be based on foreign currency, and they must be determined in Turkish lira. And in addition to these, payment obligations arising from the transactions regarding the immovable property sales and also all types of movable and immovable leases between those persons residing in Turkey are also covered within the scope of the restrictions. And moreover, except for certain type of vehicle and financial lease contracts, and although it is allowed to determine the purchase price of movable sale contracts in foreign currency, very recently, it is made mandatory to make the payments in Turkish lira on the actual payment date, even in contracts where the payment is determined in or indexed to a foreign currency. And although these FX restrictions are applicable to the certain contract types executed between Turkish residents, they also extended to cover the foreign entities which are deemed to be residing in Turkey, regardless of whether such entities are incorporated in a foreign country or not. In this context, for example, the branch representation or liaison offices of Turkish entities which are located abroad, or those foreign companies of which 50% or more of the shares are owned by a Turkish real or legal person, will be treated as residents of Turkey, regardless of their incorporation of their place of incorporation. So in practice, despite some of the Turkish entities did attempt to circumvent these restrictions through their foreign subsidiaries, they failed to do so as they are deemed as a Turkish resident due to their shareholding structures. And back in 2018, when the first significant devaluation of the Turkish lira was experienced, the consideration for introducing FX restrictions were commenced mainly with the aim of protecting the retailers who were party to the lease contracts denominated in foreign currencies. However, as seen, these measures did end up with the application of FX restrictions on a wide range of contract types. And accordingly, due to the ongoing increase of the inflation rates in Turkey and also the devaluation of Turkish lira, it is now being commonly experienced that the commercial interests of parties during the negotiation process or at the beginning date of a contract, which is forced to be denominated in Turkish lira, may no longer be reasonable when compared to the position of the parties after a few months following the execution date of the relevant contract. And without any doubt, when the inflation rates are considered together with the FX restrictions under the decree number 32, forcing off contractual parties to make a contract in Turkish lira may now be interpreted as a potential obstacle to deal in FX to protect oneself against inflation. And we can clearly say that these are especially creating unbalanced environment on the interest of contractual parties. Another problem is that the said FX restrictions also extended to apply retrospectively. So certain contract types which were signed before 2018 were also affected. Accordingly, contractual parties had to adapt their existing contracts to comply with FX measures and redetermine the contract prices in Turkish lira based on FX rates applicable back in 2018. However, in most of the contracts which were adapted during this time period, the parties didn't expect the inflation rates to increase almost 4 times during the coming years. And again, today's position of Turkish lira was not easily foreseeable. So no proper price adjustment or escalation methods were covered in the contracts. And during the recent years, this led to the increase of commercial inequalities and disputes between the parties. So if you put aside all these concerns and focus on the possible solutions, I think I should first note that there are many other factors affecting the commercial life in Turkey. So it may not be really possible to come up with a single item which would solve all of our problems. But as Ergin suggested, from Turkish legal perspective, I think the best suggestion would be the inclusion of special price adjustment methods, economic equilibrium or escalation clauses, by evaluating the potential risks that might be applicable to the different sectors which each contract is related to. And on the other hand, we are aware that the inclusion of such clauses to the new contracts, which are not yet signed, would be more practicable when compared to the already existing ones. But if it's possible, it's worth trying to making amendments to cover such price adjustment clause to cope with the existing conflicts and prevent the initiation of lawsuits for the adaptation. I think these are all that I can talk about. Decree number 32. And I can leave the floor to James for English law perspective.
Thanks, Fatos. My name is James Lockwood, and I'm a finance and commercial litigation partner at Norton Rose Fulbright. My role here today is to give an English law perspective, and this is by contrast with the position in Turkey, and also because contracts in Turkey often include English governing law clauses. I'm going to briefly consider the impact of the UK's high inflationary environment on commercial contracts and whether there's any relief under English law. So starting with the UK's inflationary environment, you'll see on the graph on the left, after a decade of very low inflation and relative stability, inflation is now back with a bang. The consumer price index rose by almost 10% in the 12 months to August this year, partly driven by shocks to energy supply and other supply chains. According to the IMF, inflation is expected to peak at over 11% before the end of the year. And in each of the next 2 years, it expects price rises to be around 9%. So far above what is our Bank of England's target of 2%. I fully appreciate it's not hyperinflationary like Turkey, but the IMF predicts that UK inflation will be the highest in the G7 next year, and in the Eurozone, only Slovakia is expected to have a higher inflation rate. Now, the UK government has sought to implement policies to curtail some of the high inflation. We had a mini budget a few weeks ago, but safe to say it spooked financial markets. We now have our fourth chancellor this year, and there is lots of instability. I briefly looked whether we'd ever had 4 chancellors in our history before, and I'm not sure we did going back a few hundred years. So yeah, lots of uncertainty here, and clearly the risk is that inflation can have a significant impact on commercial contracts. And in particular, in the absence of a price adjustment clause or inflation indexation rights, suppliers of goods and services face year-on-year reductions in the amount they can charge in real terms. Now, whilst the impact will, of course, vary case by case and sector to sector, the longer the impact, longer the contract, the greater the potential impact. Thanks, Ergin. So on the next slide, so is there relief under English law for this high inflation? The first point, of course, is to check in existing contracts is whether there's a price variation or inflation indexation clause. You'll often see sort of mobile phone contracts, streaming service subscriptions clearly state that they can rise the contract annually in line with inflation. However, after a decade of low and stable inflation, those inflation indexation clauses have been something of a forgotten clause in many types of agreement. But simply suppliers of goods and services just haven't needed them as much as they do so now. So what if there's no express contractual provision going to price adjustment or inflation? What can you do to amend the contract? There are various potential avenues of attack, and they include asserting force majeure, or that there should be an implied term that prices should rise in line with inflation. The short point is that these challenges are unlikely to work. English law holds parties very tightly to their bargains. And the mere fact that a contract is causing a supplier hardship or making a contract loss-making is not sufficient. For force majeure on the slide, Yeah, high inflation is unlikely to be a force majeure event. Force majeure doesn't have a precise definition in English law, and instead it has the meaning that's given to it by the parties. It's typically limited to obligations that are rendered impossible to perform. For an implied term, the English courts have taken a restricted view of the circumstances in which a term can be implied. They will only really intervene where the implied term is so obvious that it goes without saying that it should be implied, or where it's necessary for business efficiency. The courts have suggested a term can only be implied if, without the term, the contract would lack commercial or practical coherence. So it's difficult to see how that high threshold could be met by an implied indexation clause. We've considered various other grounds for clients to get out of contracts, including frustration, but I think the short point is that it's just very difficult. So what else can you do? I think the main point is you can explore using the general termination provisions. Can you terminate for convenience, or are there some other broad termination rights? And in some situations, termination may even be cheaper than performance. Damages could be capped at a relatively low threshold under the contract, for example. And then, absent any of the points on the slide, there's always commercial negotiation. There may be a long-standing business relationship or the prospect of a future business which could be leveraged. The company may also be happy or be open to renegotiating because whatever you are supplying cannot be sourced easily from elsewhere, and because they have their own existing contracts that they're under pressure to perform under. Again, if you just go to the next slide, that would be great. Okay, so what about, so that was the sort of existing contracts. What about the new contracts or future contracts that Ergan referred to? So what can you do if you're entering into them or amending or renewing an existing one, and what should you be thinking about? Firstly, for indexation clauses, there are a few things. Firstly, what is actually indexed? Clearly, the price should be, but what about other parts of the contract, such as service credit or liability caps? Would you, to put it another way, would you be happy with a 10% year-on-year reduction on the amount you could recover in the event of a breach of the contract? Secondly, what sort of index should be used? Clearly, different indices grow at different rates, which can make a big difference over the lifetime of the contract. Your main cost could be wages, but if you've indexed to, say, UK CPI, which is driven by rising food prices, that may not be quite right. Equally, even if you use, say, the UK average weekly earnings indices, what if your workforce isn't based in the UK? So there's just a bit of thought around that if you're going to include one. In terms of what else, you might want to cap on any annual increase in inflation and to consider how often indexation would take place. Also, one point of caution from the case on the slide, make sure you're getting your drafting right. The indexation clause would often be based on a mathematical formula. That 2021 case was regarding rent on a solar farm. The formula provided for the increase in rent every year by the total increase in inflation since the start of the contract. So not just the increase in inflation for that particular year. So that was an expensive mistake. Just a couple of final points. If you don't want an indexation clause, what about a hardship clause, which provides for the parties to renegotiate the price in the event that unforeseeable conditions arise? There has to be a degree of caution there because the English courts don't respect agreements to agree, but those hardship clauses can also work. And then lastly, just to consider carefully the duration of the contract, how long you want to be tied in it, mindful of inflation risk, and also ensure you have that flexibility in your termination provisions. So that was sort of a snapshot of some considerations in the UK, but if you have any questions for us, very happy to consider.
I'm just looking at if there is any question, but I haven't seen any in the chat box. Maybe I can just raise one issue before closing. And okay, Turkey. During my speech, I referred to international accounting standards, international financial reporting standards, and it required that Turkey is a hyperinflationary country with effect from 31st March 2022. So after this date, the foreign companies established in Turkey and preparing financial statement in Turkish lira must prepare their financial statements in accordance with inflation accounting. And these financial statements should be consolidated in the head office. So Turkey did not happen hyperinflationary country overnight. So it took a while to see the situation, and then it's assessed, and with effect from 31st March 2022, it happened. The question is that when Turkey will cease hyperinflationary environment. So of course we don't know when hyperinflationary environment will end in Turkey. There is no reason to believe at the moment that inflation will decrease very shortly in Turkey. In any way, even next year, let's say next year, the indicators will show that maybe inflation will decrease, but inflation accounting will continue for some time in order to ensure that Turkey is out of hyperinflationary environment. So I'm just drawing your attention that this is not something that it's going to end shortly, in my opinion. It's going to take some time, and we are going to see the impact of inflation in the next coming years in Turkey. And of course, at some stage, the indicators will prove that Turkey will seize the hyperinflationary environment, and then the situation will get much more normal. Maybe I can ask a question to Ergin. Because we haven't, I think we have received, sorry. Ergin, did you read the question? I haven't.
I'm reading it right now. The
I'm
question
sorry.
is, I think it's directed to Fatosh. Let me be double check.
Okay,
it's not a question actually.
No, it's from Cerebra, just asking everyone if they wanted to ask.
Okay. But my question, Ergin, maybe to you, how do you see future about the implication of inflation from legal perspective in Turkey?
I mean, it's very hard to predict because for a number of reasons. One, as you know, as legal practitioners, of course, we know about the market and we hear about the market trends. So if there are an increasing number of disputes related to hardship clauses, either statutory or contractual, we will start hearing about those. But the case law will be published by the time that the Court of Appeal decides on the issue, which may be 5 years from now. So the creation of case law, so to speak, on the effects of inflation on the contractual or statutory hardship clauses is not forthcoming in the near future. But I think nonetheless, we will see a number of cases, increasing number of cases for the implementation of the clauses that we have discussed.
Okay, thank you.
Actually, we have a question to you, so if I can read it. From Gary Barrow, he's asking, as the hyperinflation environment endures, what are the likelihood of foreign currency exchange restrictions / movement being imposed? So who wants to answer that?
I think I can answer that one. Besides the foreign currency restrictions on the denomination of contracts in foreign currency, we also have numerous restrictions on the utilization of foreign currency loans. So I think we keep expecting other foreign currency restrictions within the near future, as long as the inflation rates and the devaluation of the Turkish lira is going back, let's say.
Again, I had one really quick question on your section and the concept of hardship. Is that a principle of Turkish law, or is that something that has to be is sort of a clause in the contract? And then, I mean, that sounds very attractive. If you don't like how much your contract costs, you can go off to court. I mean, how often is that happening? How often are counterparties doing that? Are they rushing off and saying, I need my price changed? Sort of just interested in that as a contrast to the position here.
I think we have seen it a lot in the 1990s and beginning of 2000s, when there was a real economic crisis in Turkey, and we have seen it in rent disputes, especially people trying to adjust their rents, and particularly when the rent amount was in US dollars. People no longer want to pay in US dollars for their rents, so they want their rents to be adjusted to Turkish lira and to be adjusted based on the present circumstances at that time. But in my experience, I have seen many contracts governed by Turkish law where there are contractual stipulations for hardship. Seeing those clauses is one thing, but seeing their application is another. I have also witnessed an arbitration which we presented a client in the tourism sector, where a hardship clause, a contractual hardship clause, was invoked, and it was related to the terrorist attacks and the political climate in 2016 and 2017. Actually, my experience there now makes me believe that it may be much easier to attain a successful result in in arbitration, because the arbitrators seem to be less conservative about how the hardship clauses should be applied, because they don't set precedent themselves. I think there may be a psychological aspect in court judges, because once they decide that a hardship exists in Turkey, it should follow automatically that other similar applications should be granted. That's why I don't expect to see a lot of court cases, because I believe that they will likely be rejected, most of them. But I think if there are, contractual stipulations, or even the absence of contractual stipulations, when there's an arbitration agreement between the parties, we may see more, people or businesses applying for arbitration.
So I guess I don't see any questions. You've done a great job. Thank you. It was really insightful. I learned a lot. And for everybody's attention, we're recording this webinar and we will upload it onto our website so you can revisit it. And for any of participants that wants a copy, we can provide you a copy of the presentation. So with this note, I thank you, dear participants, for your great presentations. And thank you, everyone, for participating. Have a great day. Thank you.
Thank you for the opportunity.
Thank you. Bye-bye.
Thanks all.
Thank you.
Bye-bye.
Bye.